Hello, hello, hello. What's going on, everybody? How's everybody doing this Saturday? Morning, evening, night, depending where you are in the world. Could I get a quick audio and visual check before I start speaking? You know what I mean? Before I start going off? Make sure you guys can see gold on your screen. Make sure you have a clear view of the dates at the bottom, which is going to be very important, and the prices as well, which I'll name the prices where my little I'll move this up a bit. No, I should keep it right there. All right. Okay, perfect. All right, everybody. Welcome to a Capital Hungry live webinar that will be saved. You can rewatch this as you wish. Where I'm going to be giving you guys full top-down analysis on gold. And what I'm going to be going through at the start may be very boring to a lot of people, talking about the history of gold and what led to this movement from 2008 to where we are now. I'm going to be breaking down the exact impacting factors in chronological fashion, bringing you a timeline of events and what took place in the current time that is very similar. We've seen repeat in history during the 2008 global financial crisis as reference. Okay? So hopefully you guys are here ready to learn. I'm going to be doing this top-down analysis on other pairs as well, but I wanted to do one pair at a time just because you guys know I like to give a lot of information. I like to share a lot of detail about what's going on with the fundamentals, the real-world events, and of course, the order flow in terms of buyer and seller transactions that are highlighting the real-world events. Okay? So, number one, at the end of the day, whether you want to admit it or not, the market, whether it's algorithmic based trading and system based trading, which it is now in the modern age, it is all of course AI shifted trading. But at the end of the day, the majority of market moves, especially on a macro perspective, are based on an information advantage that's going to be impacting this real world trading instrument. So Gold is a precious metal safe haven, but also has major impact based on economic inflation, major impact on geopolitical issues, major impact from central banking. We're going to be starting from the 2008 period, highlighting what happened from 2008 to around 2014. Then we are going to be discussing from about 2019 all the way to the expectations of going into 2024 and so forth, okay? It's almost even a similar 6 to 7 year run and very similar economic and market cycle as well. So let's begin at 2008, shall we? For those of you who do not know, 2008 was the GFC crisis. This was the global financial crisis where basically the junk mortgage bonds in the US collapsed, leading to a domino effect and ripple effect of major institutions collapsing, leading to loss of jobs, huge ripple effect in global financial markets, and so forth. At this time of the 2008 financial crisis, the Federal Reserve head at that time was Ben Bernanke. This is before the Janet Yellen phase and way before the Jay Powell phase, which we have been more accustomed to in the recent times. But back then, the Federal Reserve head was Ben Bernanke. Jerome Powell was actually on the Federal Reserve at this time, of course, with Janet Yellen. And our boy Jerome Powell was just a young lad, a young economist trying to make it big, right? So we had the age of Ben Bernanke. And when the 2008 financial crisis occurred, what was impacting gold, of course, the geopolitical tensions of more market fear, but it was the central banking action that held the most weight on majority of asset classes, stock markets, and so forth. Because when the stock market crashed in 2008, when it led to that huge dip in equities and that fire sale bargain price being created, the reason for this is because the Federal Reserve started to keep interest rates much lower and started to execute their asset purchase program, increasing the money supply so they can start pumping up the markets in various asset classes. So at this period of time, what you had taking place was economic crisis. That's number one, right? Economic crisis leading to central bank action. That's number two. Central bank increasing money supply, keeping interest rates low, and their asset purchase program active. Okay? What the central bank, when they were keeping interest rates low and increasing money supply, what this led to was an increase in economic inflation as well. Let me make that larger so you can all read it. Okay? So, we can take away a few things from this information. We know that gold, as a fundamental safe haven in precious metal, is a risk and inflation hedge. Low interest rates also bullish fundamentally for gold to hold longer. And at this time, we have to understand something else. Low prices, right? So during the 2008 financial crash, you can see gold ended up actually doing a little bit of a quick dip, setting up at low prices, and because of the economic crisis, increasing fear, uncertainty, and doubt, then this led to the central bank, global central banks, but mainly the Federal Reserve, with the Federal Reserve head being Ben Bernanke at that time, keeping interest rates lower, increasing money supply, running through their asset purchase program at these very low prices during economic crisis. This was the reason here. This was your information advantage for the institutional macro order flow, right? Information advantage, because the market is all speculation running on information advantage, where the information advantage is coming from the market makers, being the central banks, governments and central banks working hand in hand, the corporations and major institutions down the line. This is why when you look at the structure of gold for that period of time of almost until 2012, 2013, all you had was buyers significantly printing higher highs, only having very short-lived pullback phases, while overall having the market price in low interest rates, increasing inflation, buy-side liquidity entered from very historical low price points, and of course the asset purchase program in support of the central bank during a state where the economy is in crisis mode, right? You can see gold goes from about $700 an ounce to all-time highs at that time being around around $1,900 an ounce. This was the main reason in information advantage that led to this huge upside on gold, where as an intraday trader, you would be primarily wanting to play the buys due to the economic crisis, due to the central banking action, and the central banking action impact on the financial markets. You can see this rally lasted years on gold post 2008 financial crisis, until we finally started to have a shift in two things. Okay? So now, screenshot this. This was the reason. And you can always rewatch this as you wish. $700 ounce to $1,900 ounce. These were the fundamental real-world reasons, real-world catalysts and events that led to a change in the information advantage for the institutional order flow to have a monstrous rally on gold all the way until 2012, 2013. This is step number one. The reason why I'm going through this, and I want you to really understand what is highlighted in this yellow box, is because this is going to be the exact same fundamental reasoning. We saw a huge increase in gold from from 2019 all the way until 2021. Okay? No, CB action is just like, this was step number two. Step number one was the economic crisis coming into play, the global financial crisis. Step number two after the economic crisis was the central bank taking action. These were the central bank actions taken. Okay? Now, so the economic crisis, the catalyst of a global financial crisis and crash that was induced by the mortgage-backed securities collapsing and the mortgage and the whole mortgage market in the US pretty much going belly up, leading to a huge ripple effect. That economic crisis brings fear, uncertainty, and doubt itself, which would bring more demand into gold. But what's more important is that economic crisis leads into intervention and action by the central bank of the US, working in hand with the government. The action of the central bank was increase money supply, keep interest rates low, and initiate their asset purchase program to make sure they can keep the stock market active and have a recovery on the stock market, to make sure they can keep various asset classes inflated so you don't have a full economic crisis. But what's really happening that they're not going to tell you in mainstream media is any economic crisis is always opportunity for the rich. Always, historically, always opportunity for the rich. And you can see that where this action by the central bank, it not only led to this huge upside move on gold, it also led to a large recovery in the stock market. The stock market during the 2008 period, with the initial crisis having a crash, then due to the support and intervention of the central bank, having a huge recovery because they manually intervene and start pumping up the markets, right? But we're just talking about gold today. So that was from 2009 pretty much until 2012, right? So now that we're going to clear out those fundamental events, you can see from a technical perspective on the higher time frame, all you had was buyers significantly printing higher highs, very short-lived pullback phases that would just be buyers liquidating positions at sell-side liquidity zones, pushing price up to more favorable demand zones before overall continuing the bullish trend, because at the end of the day, you had an information advantage for the institutions and market makers to keep buying into gold and to keep pooling into these asset classes. This trend, this fundamental information advantage lasted until around 2012. From the 2012 period, you can see from about 2011 after the highs are peaked all the way until 2012, you start to see a bit more of consolidation and indecision. Not enough buyer volume or information advantage to break above this 1,900 an ounce to 1,800 an ounce price point, creating a very strong zone between these significant highs and lows. The fundamental reason for this is as stated. Now, gold cycle shift, right? Years after the GFC priced in. Inflation increased. It needs to be brought down. Right? Also, during this 2012 period and going into 2013, with the exact date being May 2013, which I'll show you guys after, right? I'll show you guys here after. You also had now, at that time, Bernanke, who was the Federal Reserve head, start to talk about tapering. Right? You might be asking, what is tapering? Tapering is stopping your asset purchase program, no more increase of money supply, no more pumping of the markets. So you started to have all-time high price points hit, right? We had monstrous rally in the market moves in waves and cycles. As these all-time high prices are hit, a lot of the fear, uncertainty, and doubt regarding the GFC has been priced in. The economic uncertainty and doubt has started to fade out years later. You've had all-time price points hit, which makes it more favorable to see buyers liquidating positions. And the information advantage that led to this huge rally is starting to change. Now, instead of the Feds keeping the money increase going, instead of keeping the money pumping into the markets, instead of keeping interest rates low, you start to have tapering talks take place. In 2013, this is what was called historically the taper tantrum. The Federal Reserve at that time, Bernanke, they initiated a very aggressive tapering program that brought a shock to the financial markets. Because at the end of the day, right? At the end of the day, the potential increase of interest rates the potential information advantage of what made gold so bullish during this time is starting to shift and turn into the opposite. Remember, what made gold so bullish at this time was one, low favorable prices to buy into, low interest rates, economic fear, money supply increase, and asset purchase program by the Federal Reserve, the Federal Reserve central banking action. All of these information advantages and fundamental catalysts that led to the printing of these candles and gold being more bullish started to shift and change. Now, years later, you had the global financial crisis and economic fear priced in and digested by the markets. You had all-time high historical price points hit. You're having the Federal Reserve, instead of keeping interest rates low, starting to talk about a rate hike cycle, starting to talk about tapering, starting the actual tapering process as well. So you can see then from 2012 all the way until 2016, gold essentially enters a bearish cycle. Right? You had this huge amount of upside based on the fundamental reasons stated. Very large periods of indecision bouncing between these highs and lows. But as soon as the information advantage started to shift and you started having the tapering talks, the actual tapering tantrum, you can see gold goes all the way from $1,800 an ounce all the way to $1,100. Right? Does that make sense to everybody? Why gold was so bullish in the 2008 financial crash? The actions taken by the central banks, the buy side order flow institutionally that was going in terms of the information advantage, the shift in economic cycle from 2011 to 2012, and the shift in central banking action that led to this bearish fundamental market cycle on gold. Right? Then 2014, 2015, you also had interest rate increases. Right? Okay, now you can see after that, once Bernanke left and then Janet Yellen came into play, as we had that bearish market cycle, we didn't have a full correction of the upside move. We started to stabilize around the $1,100 an ounce region, right? Now, higher time frame, gold is still extremely bullish in structure and trend. During this 2019 phase, this was Trump era. Global trade war fear and Trump pushing the central banks to drop interest rates. Okay? Now, as you had gold price stabilize, a correction of this very large impulsive buy side move, having about a higher time frame 50% correction of that huge buy side rally, you can see the price starts to stabilize, and at this period of time is at lower historical prices compared to these all-time highs. So what you had take place that started to lead into this rally from 2019 all the way until 2022 pretty much were these catalysts stated here, which I'm going to start jotting down. Lower historical prices. Trump era, bringing uncertainty. Trump pushing lower interest rates. After the interest rate hikes we had from 2015 onward, right? Global trade war drama. And then, of course, 2020, pandemic. Pandemic leading into central bank action. CB keeping interest rates at zero. At zero, increasing money supply. Asset purchase program. What I want you to understand is this. Even though the fundamental catalyst of what was bringing market fear, we can also throw in before the pandemic, we almost had an Iran war. Remember, we almost had the world war with Iran pop off during Trump era. So we're also going to add here Iran tensions. But what I want you to understand is these fundamental catalysts here and the global financial crisis here. That's step number one. Yes, the financial crisis and economic uncertainty and doubt is going to bring more demand to gold as a precious metal safe haven and be a reason to start seeing some more upside. But that's not the main factor. The main factor is that crisis leading to intervention by the central banks and governments. That financial crisis, that fundamental catalyst leading to central banks dropping interest rates, increasing money supply, which is going to lead to an increase in inflation. Right? These catalysts leading to this central banking action of interest rates being low, of having economic uncertainty and doubt. You already had Trump with the trade war drama, Iran tensions. He was pushing the central banks to start dropping interest rates so the stock market could keep pumping during his time. The stock market was extremely bullish during Trump era all the way until the pandemic, which led to a crash, and they blamed it on Trump, even though it was just a market cycle, right? So you had economic uncertainty and doubt. At the same time, you had lower historical prices, fear, uncertainty, and doubt coming in, pushing of lower interest rates, the 2019-2018 global trade war and Iran tensions, then the main meat and potatoes, the 2020 pandemic. The 2020 pandemic led to a quick spike down here on gold before having a continued upside rally. This upside here on gold before the pandemic hit was Trump era. Trump's global trade wars, the tax man they called him, tariff man, the tensions that were bringing to the table with Iran starting to bubble, and then of course him pushing lower interest rates. Then the pandemic hit. This is where the central bank action started to explode. You had the pandemic hit, global lockdowns, of course, right? Global lockdowns, huge economic uncertainty, and then the central banking action. The central banking action was no different compared to 2008. It was just heavily inflated. The increase in money supply was much higher. The drop in interest rates was much more aggressive. The asset purchase program was far more aggressive. Right? Is everybody following along so far? So, during this period of time, for about 2019 to 2022, we saw a huge inflation and rally on gold. New all-time highs being hit. Then we start to get a shift in the economic cycles. And we start to get very, very similar technical repetition to the 2008 period as well, right? What you start to have happen is after the pandemic phase, 2 years later, the reasoning of buying into gold, the information advantage starts to shift. Right? Now, what you have is all-time high price points. COVID priced in. Lockdowns faded out. Right? Then you also have, because of the economic climate is shifting, because you had the 2 years of the pandemic, lockdowns get priced in and faded out, COVID fear get priced in and faded out, gold hit new historical all-time high price points. The Fed, Jerome Powell leading at this time, starts to talk about tapering. Taper talks, interest rate hike talks, right? So you can see there was one more catalyst that led to gold just revisiting these highs, which was really just gold to go push price up to more favorable sell side liquidity zones, and it was very short-lived. This here was the Russia-Ukraine tensions. Oh, my face blocking some of the text. Don't worry, you guys can reread this after. It just says Jerome Powell taper talks, interest rate hike talks. Okay? So, there was one more catalyst here that led to gold, very similar to the technical repetition we saw here. I'm just going to color code it for everybody now and label it one more time. Color coding always helps people visually understand it a lot better. I'll move it when I start typing up here, right? I'll move the camera down right now so you guys can read what I'm gonna put up here. I'm gonna put this over here. Same shit. You guys like to look at my face and shit. Right? New all-time high prices hit. COVID priced in and gone. Inflation too high. Shift in CB cycle. Okay? Now, what you can see is the reasoning here very similar to the 2008 global financial crisis after gold price stabilized that led into these all-time highs is starting to shift now. Very similar to the 2008 period. We've hit all-time high price points, right? COVID fear and the lockdowns are gone and priced in. Inflation is now too high where the central bank needs to start taking action. We failed to break above the same previous high price points of interest, and we're even showing very similar technical repetition to what started taking place here to at least be revisiting this demand zone and potentially having a bearish market on gold all the way until I see the potential 1400s before we'll see some more drama in 2024, 2025. Does that make sense to everybody? The fundamental reasons of the 2008 financial crisis, the information advantage that led to the upside, the all-time prices being hit in the global financial and the shift in cycle here, the central banking action that led to this shift in cycle, why we had this huge rally and the central banking action, and then the shift in central banking action up here. What I mean by the shift in central banking action is they're going from keeping interest rates low, keeping their asset purchase program, keeping their money supply pumping, to now changing that where they're starting to taper that, starting to rise interest rates and hike interest rates, starting to combat inflation, right? So I'm going to clear this out of the screen right now because now you can understand we have very similar potential historical repetition from a fundamental perspective that can take place now. But what I also want to show you guys is the technical repetition and also the potential similar movement of order flow we can assess. All right, so now I'm going to color code this and make it look even better. Now, gold is obviously bullish on the higher time frames. We can see this very nice higher time frame bullish market structure. We can see buyers had this huge rally to extend into higher highs. Huge rally to extend into higher highs. As those buyers got faded out and more sell side liquidity was generated, you have a pretty aggressive corrective move. Pretty aggressive corrective move. This corrective move here creates a very strong buyer side demand zone where you can see gold consolidate and almost be very indecisive for an extended period of months and weeks, failing to break these significant higher highs and lows all the way until you get a shift in the economic cycle fundamentally induced. But what you also have to understand is based on the candle body closures, you also do not sweep the previous highs. At the end of the day, the market moves in phases. This guy says, you're stupid if you think gold's gonna fall that low. Gold has been at these price points before. Gold seeing a potential bearish market take place with the fundamental reason stated, and the economic cycles coming into play is the reason to drive price lower in the short term. This retard said gold's gonna go up because of a cup and handle formation. Never mind. I don't know why I even answered this retard's question. This guy's looking at cup and handles. Is it a teacup or is it a teapot? Is it a coffee mug? Is it a water jug? How big is this cup and handle? Fucking retard. What a retard, eh? So, when we're looking at the technical and fundamental repetition taking place based on the real world fundamental catalysts and economic events that drive the information advantage and pushes the order flow behind the scenes, we can see that as long as the Feds keep raising rates, combat inflation, no new fear as Russia and Ukraine has been priced in, as the pandemic and lockdown and so forth has been priced in, dollar's still going to be strong. You guys aren't understanding the fundamental impacting factors on these real world financial trading instruments. Rising interest rates is still going to be keeping dollar strong as it's very bullish. The issue with inflation is the reason why gold is so bullish during this period of time was rising inflation. The market moves on anticipation, not on the actual fact. When we had rising inflation, the market was already pricing that in with gold going up to $2,000 an ounce, almost 2,100 all-time highs. What I can potentially see take place over the next week and month is us driving back down into this potential 1700s demand zone and having very similar technical and historical repetition that took place here. For us to see any further downside, we will also need a break below this price sensitivity area. The US does not have any hyperinflation. The US is not in a state of hyperinflation. Yes, inflation is very high, but the stock market going down in value, the increasing of interest rates, this combats inflation. This brings inflation down in the long term. Investors will price that in ahead of time based on anticipation in market psychology. We've already known inflation's been high for the last 2 to 3 years. That's why gold is so bullish. That's why stock market was so bullish. Now the market cycles are starting to shift. You can't just look at a cup fucking pattern and start to see that you want the same thing to take place. Right? So now, we're getting a shift in the economic cycle. Increasing of interest rates. Dollar very bullish because of the increasing of interest rates. All-time high price points hit on gold and fading out. Very similar technical and fundamental repetition. No more asset purchase program by the Feds. Not as much stimulus by the Feds or pumping of the markets. Inflation starting to be combated by the increasing of interest rates, by the correction on the stock market. Right? So, what we can see on gold now when we're zooming in further and looking at the order flow is clearly there was not enough buyer order flow in the market to bring us above 2,000 or trade above 2,000. You have to understand, we had Russia-Ukraine tensions come to the table, and it led to a surgical rejection at this price point of interest on a dime to have buyers liquidate positions, more sell side orders enter the market, and still be closing below these previous candle body lows to the left. Right? You can see the previous bullish candle getting completely canceled out after this price grab to the upside, showing a lot less buyer volume as you have the Feds raising interest rates, tapering their asset purchase program, starting to combat inflation, starting to see the stock market correct, starting to see dollar increase in value. What I'm expecting to take place here is if we cannot fade these highs, if we can't break that bearish market structure, then we're still going to have pullbacks in continuations to this demand zone at 1700. Now, the beautiful thing about what I'm talking about is I've already predicted this. You can go check out the last gold webinar where I predicted that if we sweep these highs and fail to break, we're going to start coming back down because of rising interest rates, because of increase in dollar value, because of correction on the stock market, because of inflation starting to be combated and investors pricing that in, and a lot of the fear, uncertainty, and doubt fading from the markets. Russia-Ukraine tensions are priced in unless NATO countries get involved from a physical standpoint. COVID's done. Lockdowns are done. Economies are starting to recover from that potential phase, and the central bank cycle starting to shift. So you can say all you want about you thinking gold going to the moon. I've already predicted this movement in this repetition taking place in previous webinars on this channel that you can go check. So the fundamentals are being validated by the order flow movement and the transactions between buyers and sellers. What I'm expecting is very similar now to the 2008 period, where you had these highs printed by buyers, fail to sweep out those highs, and you can see very strong sell side structure regardless of some potential pullbacks that drives us all the way back down to this demand zone low. Right? No, the monkeypox is just fucking noise. It's not leading to lockdowns and shit. Listen, a lot of you guys are just a little bit fucking stupid. I encourage you to go watch the dollar timeline webinar where I literally called upside on the dollar. Where I literally called all of this upside on the dollar for the last year that we've been playing. Understanding the central banking impact on the markets and what really matters fundamentally. Not fucking monkeypox yet. Not gas prices and gas fixing. No. The central banks are the cartels of the currency. They dictate the supply, the demand, the stimulus, the support for the economies or lack of. That's what they're the market makers for the currencies. I don't know if you guys fucking understand that or not. What they do behind the scenes in terms of impacting supply and demand and talks about impacting the interest rates and so forth, that's what really has major impacts on the economies and impacts on these charts. The reason why the stock market rallied from 2020 all the way until 2022, even though COVID was still going on, even though COVID was still in the news, even though there was new variants being discovered, even though there was this fear, why'd the stock market rally then? Answer me that, you pessimistic motherfuckers. Why'd the stock market rally then? During this period of time, COVID was rampant. Some countries were still on lockdown. You still had all this fear, uncertainty, and doubt in the news every single day. Omicron variant, Delta variant, new variants being discovered. Why is the stock market so bullish? Riddle me that. If you're so smart about your fear, why was the stock market so bullish during all this time of uncertainty and doubt? Why? Because of the Fed literally pumping the markets, increasing the money supply, keeping interest rates low, fire sale low prices, pumping the markets. Now, why is the stock market turning more bearish now? Is it because of Russia and Ukraine? No. Is it because of monkeypox? No. Is it because of COVID? No. Why is the stock market in a bearish cycle now? Why? What's changing? Did the central bank start to do their tapering process? Is the central bank starting to raise interest rates? Are buyers liquidating positions from all-time highs the same time you're having tapering, increasing of interest rates, US dollar picking up strength? That's why. It has nothing to do with deflation. It's the action of the central banks. I'm validating to you on that chart. It's right here. It didn't matter when a new Omicron variant or Delta variant was discovered. It didn't matter when Russia and Ukraine tensions were coming into play. All that mattered was the central banking action. Because they're the market makers at the end of the scene. They're the ones who drive the lending rates down the line, the credit allocation down the line, their asset purchase program, which literally pumps up the markets. They're the ones who printed out $18 trillion worth of US money supply and only gave $2 trillion to the citizens as a distraction. Here, guys, here's $1 trillion stimulus package. Here's another $1 trillion. You fuckers are going to get $600 a week, while the other 18 trillion, we're going to fucking pump the markets. You get what I'm saying? Does that like spark some light bulbs in your head? It didn't matter if COVID had new variants. It didn't matter if Delta variant was coming out. It didn't matter about Russia and Ukraine tensions. All of those impacts are short-lived. They're not gonna overtake the central banking action. Do you understand, everybody, now? Right? So now, when we're looking at dollar here, why? Do you know why dollar was so bearish from these specific highs and then bounced from these lows? What, during this period of time, you had a huge increase in money supply, low interest rates, and the demand out of the dollar being removed. An increase in money supply, high supply, low demand is just economics 101. That means lower price. So you had, during this period of time, the Federal Reserve was willing to devalue the dollar so they could take that dollar supply, they could take that demand, pump it into the stock markets. Why has the dollar been so bullish ever since late 2021 here? Well, the economic cycle, the central banking action started to shift. As we hit these very historical low price points, then you had the Federal Reserve talk about tapering, starting to increase interest rates, their increase in interest rate hikes coming into play. That's all fundamentally bullish for the dollar. When you're looking at the dollar now in the higher time frame, if we have the continued increasing of interest rates, we have a correction on the stock market, dollar can easily start making its way up to 120s, 118s. It's been here before. Right? No. Buying into the dollar doesn't increase inflation. Investing into the dollar or institutions buying into the dollar doesn't increase inflation. What increases inflation is the central bank increasing the dollar money supply. Let me show you guys a chart right here. All right? Let me show you guys something. I'll show you guys exactly on the dime, even though I've done this before. The main impacting factor, and exactly on the exact same fucking date, right? March 2020. Look at this date. This is a US money supply chart. And now I'm going to pull out to you guys an inflation chart. Okay? What leads to a direct impact in inflation is the increase in money supply. Look at this. I want you guys, it's so fascinating. Come here and look at this. Ready? Look at this. So, this is your US Consumer Prices Index, which will show you inflation increases in your cost of goods in the US, right? Look at the date. March 2020 when the pandemic came into play. March 2020 when the pandemic came into play. The pandemic itself, the coronavirus, that's not going to lead to an increase in inflation. No. What led to economies becoming stagnant and what led to the increase in inflation and the shift in market cycles was coronavirus coming in, the governments around the world locking down economies and shutting down economies. Then the central bank, Federal Reserve, exponentially increased their money supply. Trillions of dollars, almost $18 trillion in increase. All on March 2020. Now, let me show you something. Look at the dates. Sorry, I don't mean to get so fucking aggressive. This is so interesting. Remember this fucking date. March 2020. The first number one factor was the increase in money supply. The increase in money supply led to a direct increase in inflation. 1-to-1 ratio, hand in hand. But not just that. Let me show you guys something. Remember the date. March 2020. Don't forget this date. March 2020. As soon as the feds increased money supply and they started doing their asset purchase program to pump the markets, look at this fucking date. March 2020 on the dollar. What happened? As the feds increased money supply exponentially to take that money supply and start pumping the markets, March 2020, what happened to the dollar? Tanks in value. Why? Oversupply, less demand. Jeev, you might be asking, why is there less demand in the dollar? Where would the demand be? Where did the demand go? March 2020. March fucking 2020. The feds take that huge increase in money supply as interest rates are low, as the stock market is at fire sale prices, historical low prices. They debase the dollar value in the short term because they don't mind devaluing the dollar in the short term, because what's more, listen everybody, ask yourself this question. What's more important for the ruling elite, the 1%ers? Having a strong dollar or having stronger stock markets and stronger asset classes? It's not just stock market and gold that pumped March 2020. When did the oil crash happen? Let's look at oil here. Oh! What do you fucking know? It crashed in March 2020, then had a huge recovery ever since then. Look! Look at the dates and times. Right? Look, March 2020, do you think this is random? You think that was by coincidence? You think that was by chance? That as soon as the Federal Reserve increased their money supply, that as soon as they increase the money supply, inflation starts going up, dollar gets devalued, stock market starts having its rally, oil goes from minus $40 a future and starts having its rally. I also want you to look at one more thing, March 2020. Back to gold here. March 2020. Didn't gold have a very aggressive dip before it started its rally? Come on! Come on! You know what also had a huge rally? The real estate market. because the asset purchase program by the feds, the purchasing of mortgage-backed securities, very low interest rates, the increase in inflation. Now, you're telling me, conveniently, the same time we're starting to see gold correction, the same time we're starting to see a bit more oil exhaustion at these highs, the same time you're starting to see US 30 bear market and correction at these highs, you're telling me it's not correlated one-to-one with central banking action now? All I'm trying to explain to everybody here is there's always going to be tons of fundamental catalysts. Oh, this and so forth. The reason why assets are dipping is because the conditions that made assets so favorable to invest in at the crash are no longer the same. During the crash, you had low prices, increase in money supply in support of the central bank, low interest rates. Low interest rates makes it more favorable to invest in the stock market for the banks. Lower rates on lending. Lower interest rates makes it more favorable to buy into the housing market and real estate. Why do you think when you're looking at a real estate ETF, oh, what do you know? March 2020. Who would have guessed that even the real estate market is following the same exact pattern as these other asset classes? Why did the real estate market rally in March 2020? Why? Low prices, low interest rates, asset purchase program in support of the central bank. Why is the real estate market now starting to enter a bit of a bear market and correction? Extremely high price points, no longer as favorable to invest in at high price points. Central banks starting to shift their policy stance, decreasing their asset purchase program, starting to taper it, increasing interest rates. Why would smart money investors, why would institutions want to be buying in real estate at the all-time highs when interest rates are going up? Duh! Why would smart money investors in the institutions want to keep buying in the stock market from all-time high price points when the Fed support is leaving and interest rates are going up? The information advantage that made it favorable to invest here and keep buying into the stock market is starting to shift here. Does that make sense now to everybody? Those connections, how the market is interconnected, how these asset classes are moving as one, all based on central banking action, the true market makers. Oil, same path. Gold, same path. Real estate market, same path. Equity market, same path. Dollar following exactly what was expected based on central banking action. Right? All starting out March 2020, as soon as the Feds chose to intervene. Remember, they let the housing market crash to a certain point. They let oil crash and go below zero. They let the stock market crash. They chose when to jump in and intervene and start taking action. Why did they let the markets crash to certain very low price points? Because every single crisis brings an opportunity for the rich. Who do you think was invested in the stock market over the last 2 to 3 years? In real estate, in commodities, in gold? You think it was the average day-to-day worker? You think it was the masses? You think it was the regular day-to-day citizen? No. It's the 1%ers. The ones who have the liquidity to shift these markets. The ones who are riding the wave of the central bank. Am I starting to connect dots for you guys? Are you starting to connect those dots and piece this puzzle together now? It's all correlated. It's all pre-planned. It's all surgical. It's not random. Right? So, now when we're coming back to gold, when I'm looking at gold in the similar technical and fundamental repetition, of what took place in the 2008 financial crisis and what we're seeing now, listen, I'm not here to say that gold is going to be forever bearish now, but if gold wants to enter a bearish corrective market to the 1400s before continuing further bullish again, that's perfectly normal. Because what made investing in gold so favorable here and here? What made investing in gold so favorable here in 2008? Those conditions are not the same at these all-time highs. It's okay that you said I'm stupid. It's okay. Shit happens. I'm not gonna take offense to it. But as long as you understand my thinking, right? So when I'm looking at gold now, the technical repetition's looking very similar to this piece of the pie from 2008 period. Will we have some very aggressive pullbacks? Yeah, of course. That's how the market moves. But as long as gold sellers keep printing consistent lower lows, I expect us to be trending down to revisit the same demand zone here. Now let's go look at current period of time on gold. As long as gold respects this bearish market structure and sellers keep printing lower lows, I can easily see us still pulling back to 1860s, but I'm expecting us to drive lower into the 1700s. Okay? Now, let's dive down even deeper into our analysis on gold. You can always rewatch this as you wish in full detail, you know what I mean? I know you feel stupid about that cup and handle pattern though, but it's okay. We're not here to judge. We just joke around. We can talk shit about each other because we're traders. We have thick skin. We're used to we're gonna get fucked around more by the markets than anything else. What's gonna impact our feelings more than anything else is the markets. Losing trades, having incorrect analysis. But us swearing at each other in the chat, think about this like a modern trade floor. We're still trying to help each other and give each other value. We're still trying to share information. But if we talk a little bit of shit, it's okay. Who gives a fuck? We got bigger things to deal with in life, especially as traders. You know what I mean? So it's okay. I don't take any of it personally. It's all good. All right. Now, when we're looking at gold here, of course we have to analyze some key price sensitivity areas of interest. It's very high probability here that gold can have an aggressive pullback and bounce from this buy side demand zone, taking us into the 1860s and 1880s before potentially driving lower. Remember, Russia-Ukraine tensions were priced in, sweep the exact same surgical highs, had buyers liquidate positions, more sell side orders collected. We can see the consolidation and fail to break higher, more sell side orders generated here. We can see the stronger bearish price actions throwing us more stronger volume. Now I'm going to dissect the lower time frames even more as we go in. Do you know what the reason for this huge outflow here was? April 21st, April 22nd. Those days, there was a IMF meeting, the International Monetary Fund. Normally, I don't give a fuck about the IMF. But what was very important about this IMF meeting was all of the main central bankers came together to have a meeting at the IMF, whether it was digital or online. Euro Central Bank, Bank of England, Bank of Canada, Federal Reserve as well. Here, they started giving rumors of increasing interest rates. This is what led to a change in the information advantage and much stronger bearish market structure being formed here on gold. What you're seeing take place here on gold ever since that IMF meeting and ever since the increasing of interest rates is sellers in control. Sellers consistently printing lower lows, only having very short-lived pullback phases, which is sellers exiting and liquidating positions, pushing price up to more favorable sell-side liquidity zones before still continuing overall bearish respecting the fundamental sentiment in play. Now, the one thing we have to look out for is this buy side liquidity zone we are starting to tap into. But when we're analyzing market structure, we could easily have gold still push up to these previous lows and sell side liquidity zone even around 1870s, high 1860s, low 1870s. In my opinion, we would still be having the integrity of bearish market structure being respected and seeing potential moves to the downside to revisit these lower lows, as overall sellers consistently are printing lower lows and only having short-term pullback phases that get faded out of the market to collect more sell-side liquidity from better price points of interest, because the information advantage influencing the institutional order flow is the aggressive rate hike cycle, the all-time high price points being hit, a lot of the economic fear, uncertainty, and doubt being priced in, the potential of inflation starting to get combated. Does that make sense to everybody? When we're looking at gold in top of our key levels as well, this was just some intraday structure, right? We have to look at the sell side and buy side liquidity zones. Our last significant low printed by sellers was around this area here. Right now, what we're having taking place is short-term corrective pullback structure. Very similar to what you had take place here. Minor pullback here, minor pullback here. This is just a little bit of a larger pullback in corrective phase. No matter how large these pullbacks have been, which fakes out a lot of institutional retailers to jump back into buys, the majority of these pullbacks get faded out as you have buyers push up price to a more favorable sell side liquidity zone before continuing the overall bearish market and trend to the downside. Is everybody following along and understanding now? Right? So, fundamentally, macro higher time frame, after all-time high price points were hit, Russia fears priced in and faded out, central bank interest rate cycle starting to shift, tapering starting to take place, interest rate hikes starting to come in. The macro sentiment in play is bears, sellers in control. But of course, the market moves in waves as you have buyers and sellers transactions entering the market. Every time we have these significant lows printed, we enter some type of short-lived pullback phase, which is exactly what we're seeing now. Fucking lights are going off in my room. Hopefully my power doesn't go out. Let's finish this up first before my power goes out. So, on the intraday time frames, I could personally still see us having this upside move all the way up until the 1870s, high 1860s, low 1870s, before having more sell side liquidity generated in the market and coming right back down bearish again. It's fucking pouring out rain. Can you guys hear that? Do you guys hear the thunderstorm or no? I'm having a crazy thunderstorm coming, so it's flickering my power. So I gotta wrap this up before shit goes blank, right? You guys hear the thunder or no? It's still clear audio, yeah? It's fucking loud as shit. Alright, anyway, so when I'm looking at gold here, based on some of these historical key levels, what I'm potentially looking for is some short-term upside still, digging into that 1870s area, and then seeing the institutional sellers come back into play. Okay? Or I see us jumping right back into the sells back below 1828s, where if we don't have that deeper price grab up to collect a lot more sell side liquidity with the buyers fading out, and we just start to jump back in with our higher time frame trend, I would be looking for sells back below 1828s. But all I'm essentially looking to play is analyzing when this corrective pullback phase is going to be completed. Right? All of these various pullback phases being extremely short-lived, where you can analyze it either as a short-lived consolidation phase to generate more sell-side orders, or a short-lived pullback phase. But all I'm looking to identify is either one, coming up to a more favorable sell-side liquidity zone and jumping back in the sells, like you saw here, like you saw with this order collection here, this revisiting of the previous lows, or breaks below this corrective structure and driving back down. Does that make sense to everybody? Okay, great question, Adele. In my opinion, fundamentally and technically, the sells would be invalidated for some multiple reasons. One, if we have any new fear catalyst comes into play that brings new fear, uncertainty, and doubt to the markets, that's something we already haven't seen and that's not already priced in. Let me give you guys an example of something that could take place. If we have Russia tensions escalate, what do you mean by escalate? If we have NATO countries like US, United Kingdom, countries in Europe actually get involved from a physical military standpoint, not just sanctions, which already priced in, not just keep talking shit politically saying, oh, what Russia's doing so bad. No, none of that noise. If US starts to send their military troops, then I could see gold sells being invalidated and continued buys. The only way I see continued buys on gold above 1870s here is either Fed's reverse rate hikes, actual physical intervention by Russia, by US and NATO into Russia, into Ukraine, sorry. Something else could be like if this fucking monkeypox bullshit leads to lockdowns. Not monkeypox itself. Remember, the coronavirus itself didn't impact economic activity. The coronavirus didn't lead to jobs being lost. The coronavirus didn't lead to businesses being shut down. The coronavirus leading to lockdowns led to an impact in economic activity. So if monkeypox leads into lockdowns, if that comes up, then sure. Then that's new market fear. You get what I'm saying? Right? If China invades Taiwan on a physical standpoint, that could bring some new market fear and global uncertainty as well. And breaks above 1870s. Breaks above 1870s with any of these catalysts, Feds reversing their rate hikes, actual physical intervention by NATO countries into helping Ukraine, not just sanctions, not just sending out military support in terms of weapons, but actually getting almost a world war starting to develop, that would bring more demand into gold as a precious metal safe haven. But the Russia-Ukraine tensions and the sanctions priced in. COVID and lockdowns priced in. Interest rate hikes is what's active. Monkeypox, no actual economic impact yet. You know what I mean? Does that make sense to everybody? I would only be jumping back into a higher time frame gold bullish bias or intraday bullish bias above 1870s with a fundamental reason to see more demand in gold as a precious metal safe haven. Does that make sense to everybody? Because then you have a break of the intraday structure which shows you more buy-side order flow entering the market, with also an information advantage of why gold is going to be bullish. Otherwise, we can't just start to jump back into buys. You know what I mean? The recession's going to have more of an impact on US economic data rather than something like gold. Okay? Yeah, severe thunderstorm right now, everybody. But, whew, that was a long webinar. It actually made me really hungry. I'm fucking starving right now because I didn't eat anything yet this morning. I've been trying to fast more in the morning, do some intermittent fasting in the morning for my digestive system. Reversing rate hikes, like they start to cut rates back down again to keep the stock market pumping. But right now they're in a rate hike cycle. Okay? Quantitative easing is pumping the markets, QE, putting money into the markets. Quantitative tightening is the opposite, tapering. What actually is a hike? An increase in interest rate. Are you guys fucking a little bit retarded? What do you mean, what is a hike? An increase in interest rate. Listen, if you guys rewatch this webinar, I guarantee you will learn a lot. All right? All right, everybody. Thank you for your time. Thank you for all the questions in the chat, the interaction in the chat. Hopefully you guys enjoy webinars like this. I'm going to be doing another full higher time frame breakdown on GBPJPY next. Monthly down to 4 hour and so forth. Telling you guys about the historical, fundamental, and technical repetition. That'll be probably sometime this week. I'll send you guys a link. I'll do GJ next, GBP USD, and so forth as well. Okay, everybody. Thank you guys for tuning in this weekend. Hopefully you guys enjoy webinars and stuff like this. You're not supposed to ask questions. You're supposed to learn first. Pay attention. One more thing psychologically. In the modern age, due to social media, due to all the pleasure chasing by people, due to the dumbing down of society, a lot of people have very, very short attention spans and very, very limited IQ due to their own decisions. Most people spend their time on social media, scrolling memes, scrolling videos and shit, watching random TikToks, playing video games, jerking off their dicks all day, on Netflix all day watching shows. Attention span decreasing, mental fortitude decreasing, IQ decreasing. The reason why I call people retarded is because the regular day-to-day person is retarded now. Right? All of us start out retarded. All of us start out with a blank canvas in our brain. We have to actively choose day in and day out what information we put up here based on our decisions, our habits, our actions day in and day out. The modern masses, including a lot of people in this chat, every single day they are repeating destructive habits of putting straight retard shit in their brain. Just entertainment, just mindless content, nothing productive, nothing informative, nothing valuable. Just mindless consumption. So the masses' mental health is declining. The masses' physical health is declining. The masses' IQ is declining. But the 1%ers who run the world, the ruling elite, they love that. The ruling elite don't want people who are mentally and physically strong, who can think for themselves, who use logical and critical thinking. No. What they want is mindless consumers. The average person now is a terrible human being, but a perfect consumer. All they do is mindlessly consume. Whether it's through mental consumption, whether it's through physical consumption, whatever it may be, substances, media, drugs, shit, food, it's consumption. But that consumption feeds the pockets of the ruling elite. It makes them richer and richer, right? But now, What we're seeing is that if we want to make changes with that, we have to change our habits, what we do every single day. We have to cut out all this noise, all this bullshit. And we have to focus on what matters in terms of bringing value to ourselves, living a productive and fulfilled life. Listen, as angry as I may seem, as much of an asshole as I may seem, the markets gave me that thick skin. And as angry as I may seem, or as much of an asshole as I may seem, I personally love my life. I love where I'm at physically. I love where I'm at with my confidence. I love where I'm at with my knowledge and experience and feeling fulfilled and productive every single day. I love where I'm at financially. I love my life. The reason why I'm so aggressive and angry is I want other people to love their life. Let's really honestly ask ourselves this question, eye to eye right now, man to woman. How many people in the modern society do you think actually love their life? Or do you think they hate their life and they numb out that misery with short-term pleasure and dopamine? How many people will be scrolling on social media and will be watching something on Netflix and you're not even actually involved in it? You're not even enjoying it. You're just doing it to kill time. You're just doing it to keep yourself busy, numb yourself out, distract yourself. Right? So think about that, everybody. You know what I mean? I'm just trying to boost people's knowledge, productivity, value, but I can only do so much. You have to take your life and you have to take action for your own life and push yourself to the limit. You know what I mean? But that's what the way this societal game is set up, that's what the ruling elite wants. Why do you think 1% of the population controls the wealth and resources of the other percent of the population? You know what I mean? Why do you think that is? It's because the 99% are nothing but followers, consumers, and mindless zombies. And this is being proven because mental illness and mental health issues are going up, depression's going through the roof, physical obesity and physical ailments are going through the roof, finances for people are going down, people are more in debt than ever, people are fatter than ever, people are uglier than ever, people are dumber than ever. How can you say you love your life and you're in that situation? You don't love your life. You're just trying to cope with your life. But I'm not trying to make this into a psychology webinar. If you guys go to the Capital Hungry page, click the playlist section, you can find the self-development psychology playlist where I'll give you as much information for free on how you can boost your life. Everybody, thank you for your time. Take care. I'm out of here. See you guys all next time. Have a great day. Have a great weekend as well. I'm a little bit angry that it's thunderstorming now in Toronto. I wanted to go enjoy the weather, but take care, everybody. Love you all. Inside, I love and appreciate you all, whether we joke around or not.